Testing 1, 2, 3. Testing 1, 2, 3. The bulk of Americans cannot afford homes anymore, and I told people this was coming. I told people it was going to happen. But first, before we get to that news and a little bit of Janet Yellin and Fannie Mae hijinks, hear this from CNBC.com. Dollar index rises as gold falls to March low. However, I'm never worried about gold. I'm heavy in the gold. I believe in gold, a soul of gold. Yeah, it's going to go a long way. The US dollar index, especially with the dollar in jeopardy in many, many ways. The US dollar index hit a high of 106.82 on Friday following the September jobs report. That was still off its high from earlier in this week when it rose to the highest level since November 23rd, 2022. Meanwhile, gold fell to a low of $1,823.50, its lowest level since March 9th, but they're not going to add in that there was a huge amount of gold just purchased by a few central banks. It says here, gold is on pace to end the week down more than 2%, which would make it its third consecutive weekly loss. If any of those banks go down that are swaying in the wind because of their commercial real estate guillotine that they've had to place their necks within, then gold will skyrocket when all the bank runs begin, when the banks begin collapsing, and a lot of them are in big trouble right now. Gold, silver, and platinum will skyrocket like it did before this past spring. But we'll wait to see if that's going to happen. I think it definitely is. It says here, gold miners were lower by 1.3% in pre-market trading, with Coeur Mining, Eldorado Gold, Gold Fields, Newmont all falling almost 2% or greater. That was written by Gina Francola. Let's move on here to the VIX Information Volatility Index. VIX hovers near 20 following jobs report. The SIBO Volatility Index, known as the VIX, jumped more than 1 point to trade near the 20 threshold following the jobs report. The VIX, which tracks the 30-day implied volatility of the S&P 500, had topped the psychological level earlier this week, the first time since May, as investors grappled with surging bond yields, which we've been covering here, by the way. A lot of people have been feasting on those bonds, feasting on those T-bills, right? Making disgusting gains. You know, if you're wise, you try to make money at all times. You know how to make that money at all times, right? It says here, the index looks at prices of options of the S&P 500 to track the level of fear on Wall Street. That was written by Yoon Lee. Let's end off the stock market news here. Stocks making the biggest pre-market moves. Here are some of the names making moves in the pre-market. Levi Strauss shares slipped 1.2% after the apparel maker cut its full year sales forecast. Interesting. Levi's fiscal third quarter revenue, I keep wanting to say levy because of, popular TV character, Levi's fiscal third quarter revenue came in below expectations, but earnings per share beat estimates. Philips, the stock fell 9.6% after the U.S. Food and Drug Administration said the Dutch health company handling of its 2021 sleep apnea device recall wasn't adequate. The FDA said additional testing was necessary. Shares of rival ResMed added nearly 3%. Tesla, everybody's favorite Tesla, the one that everybody talks about, so easy to make money with. Is it that easy during a bear market? Maybe. Tesla, the EV maker stock, shed nearly 3% after Tesla cut the price of some Model 3 and Model Y vehicles in the U.S. Yeah, but they have a lot of competition on the rise, correct? So they have to compete. Not only that, a lot of people are coming to the realizations, replacement battery prices and certain breakdowns in certain technological aspects have been making the rounds virally. So, Tesla has to adjust, and they do a pretty good job. I will say that. The move came after the company's third quarter vehicle production and deliveries update missed analyst expectations. All right. So now let's move on to that home news because people need places to live. And right now, it's very difficult. A lot of these youth out here, I got to say the youth because a lot of older people already have positioned themselves. We've bought homes, and land, things like that. But a lot of the youth coming out of college, going into college, or just, they're going for a master's degree or such. They haven't developed to that level yet. They're looking for apartments, saying apartments are too expensive. They're looking for homes. Homes are too expensive. So let's cover this a little bit here. This is from the title of it is "Homes Are Now Unaffordable" from Yahoo News. Homes are now unaffordable in 99% of the U.S. for the average American. All right, let's find out what's going on here. It says housing prices are growing more unaffordable, even with astronomical rise in mortgage rates, which we covered yesterday, putting ownership out of reach for millions of Americans. There goes that American dream, huh? That's according to a new report. You have to be wise with planning out capital, planning out children's lives, planning out their way through college. What kind of savings do you have? Where is all of this going to end? Everything has to be planned. You cannot leave this on the companies. You cannot leave it on the government, period. You have to take your destiny into your own hands. Let's keep going here. Housing prices are growing more unaffordable, even with the astronomical rise in mortgage rates, putting ownership out of reach for millions of Americans. That's according to a new report published by real estate data provider Adam, which examined 572 U.S. counties and determined that median home prices in 99% of those areas are out of reach for the average income earner, who makes about 71 average income. All right, because a lot of people think everybody's making over 100,000. Yeah, in fact, everybody's making over $120,000. Is that so? I hear so much from people. My goodness, and I just say to myself, I can respect that maybe they have a different experience in life, but what I'm interacting with thousands of people per week, and they're telling me things. And this is more in line with what I see people making, what I hear people making. It says the average income earner makes $71,214 annually. All right. So now that's established. This quote, the latest trend, and that doesn't leave a lot of wiggle room. Let me add in there, when we're hearing that those people in that income range on up to $120,000 are struggling living paycheck to paycheck. Not all, but a great portion of them. You can look these articles up and see for yourself. Okay. So there's a bit of struggle there. It says here, the latest trend continues a 2-year pattern of home ownership getting more and more difficult for average U.S. wage earners, unquote, the report said. Affordability is worsening across the country thanks to a third quarter spike in both home prices and mortgage rates. Combined, the two have helped to push the typical portion of average wages nationwide required for major home ownership expenses up to 35%. So once again, a big portion of this is psychology as well. So people have to be taught to tighten up their belts a little bit, save a little bit. Maybe you can't, times change. So in the past, maybe people were taking 6-7 vacations a year. All right, maybe 3. But maybe you can't take 3. Now, maybe you take 1 or 2 and you save some of that capital so you can buy a home, but people aren't doing that now. I'm reading the articles. I'm watching certain economic videos. And people are still, they're taking trips here. They're buying their favorite car, expensive car. They want to look nice and dapper. And so that capital could have been saved for something that is, maybe you have to buy an initial home. Maybe you want a bigger home or something. I don't know, some land. But you have to have the savings for that and the mentality to save and budget correctly for that. Am I going insane here? Is this out there? I don't know. It says, quote, the latest number is considered unaffordable by common lending standards. Well, let's take into account wage growth is going down, right? Everything else, the price is going up. But don't worry, in the next chapter here, Fannie Mae has some tricks for you to try to make things a little bit better for the people. We'll see if that works out. Little too late sometimes. Says, quote, it marks the highest level since 2007 and stands well above the 21% figure from early in 2021, right before home mortgage rates began shooting up from historic lows, unquote. There are several reasons to blame for the worsening affordability crisis. Yes, there are. But once again, I think the best mind state, let me put it this way. I think the best mind state is not to leave everything in the hands of the Fed, the government, the companies. Yes, they play a huge part, but do we not have to survive no matter what they do? Yes, we do. Yes, we do. So we have to take our destinies into our own hands, right? Everyone who acquires something had to make some sacrifices, had to go through some tough times and make some tough decisions. It's not going to be any different for the people these days. That's how I feel. That's how I look at it. The Federal Reserve's aggressive interest rate hike campaign sent mortgage rates soaring above 7% for the first time in nearly 2 decades last year. Yeah, there's a lot of greed going on as well out there as well. I got to put that in there because it's very true. So let's move on here to this article. This article is from forexlive.com and it's titled Janet Yellen. Guess who's back? Guess who's back? Back again. Yellen's back. Hopefully it's not a trend because every time Janet Yellen comes out, no disrespect, she has something to say that's just, it either is very bad or it just doesn't make sense, in my humble opinion. No disrespect. It says here, Janet Yellen says U.S. over-dependent on China for critical supply chains. Yes, but how are you going to switch that? Who can replace what China does? No, Mexico cannot do it. And they're on the come up. They're not going to negotiate the same way that China does. They're not going to operate the same way that China does. Yes, a lot of U.S. businesses have moved to Mexico. Mexico is definitely on a rise. But who can do what China does? Come up with solutions. They ask these questions. They put these thoughts out there to make you believe that they're doing work. But what are your solutions? Let's read this little tidbit here. It says U.S. Treasury Secretary Janet Yellen said that the United States has become overly dependent on China for critical supply chains. This has been for decades. You know this, Miss Yellen. It says Yellen was speaking at Fortune CEO event in Washington, adding, the U.S. does not want to decouple economically from China. You can't right now. That would be self-destructive, to say it in a nice way. Next bullet point, the U.S. would face national security concerns without a robust semiconductor sector of its own. Yes, but the way you went about it was very injurious to your relationships with China, because you, in retaliation for what they were saying they wanted to attempt with Taiwan, the U.S. went in aggressively and pulled out their scientists that were working on semiconductors from China. And then a few months back, the U.S. had said, well, we're now ramping up our efforts to produce semiconductors en masse on our own, which is also very injurious and in spite of China. So the things that you're doing, that your government is doing, are very antagonistic of China. Not that China is not doing things that are antagonistic to the U.S., but what really matters to us are our relationships and what our government does. We do have a say in it. I think we have a say, I think. So that's what we concentrate on here. So you have to take that into consideration. My apologies. So will the U.S. be able to produce semiconductors at a rate that China once did? That and at the prices that China, obviously not in that way, not when it comes to the pricing of what China is able to do with the materials that they're able to acquire, which is that's a complete other thing to cover as far as the resources that are going to be accessible to the United States and China from certain regions. Just as one example, Africa, because the relationships are completely changing over there. And because of that, the access to resources is going to change as well. But now let's move on here to a little bit of Fannie Mae hijinks. They think they have a solution. Let's see if they do have a solution. All right. So this is from mortgagereports.com and it is titled Fannie Mae introduces 5 down payment options for multifamily homes. They want you to have a multifamily home or do that. It says here, lower down payment requirements for multifamily homes. In a significant policy change, Fannie Mae has announced that starting from the weekend after November 18th, 2023, it will accept 5% down payments for owners occupied 2, 3, 4 unit homes. This marks a departure from the previous multifamily financing requirement of, get this, 15 to 25% down payments for duplexes, triplexes, however you say that, and fourplexes. this new option presents a great opportunity for individuals and a great opportunity for Fannie Mae and its friends, because the people are outright not buying anything. And you do want to make some money, don't you? Yes, you do. You want to make some money. So you got to bring those people back. And right now, the people are they're just stalling themselves out. They're sitting on the side saying, we're not buying anything. We're going to live in a car. These are facts. They're going to live in vans. These are facts. They're looking at tiny homes. They're moving back home with their parents. So you got to bring them back somehow. And they're hoping that 5% does it. Will it? We will see in some time. We'll get the data and then we'll go over it at that time. But this is quite interesting. Quite interesting. They're beginning to have to bend, to the people, so to speak. Or rather, I say it's beneficial to the people that these companies have to bend to survive. So now that you have that information, what are you going to do with it? I know what I'm going to do with it. So until next time, folks, let's get to the money.